No matter how hard they work, most Americans just can't seem to get ahead. The fact is that the wealth generation game is not played on a level playing field. Taxes are used to confiscate your hard-earned income before you even receive it. And more is confiscated when you use the money that is left to buy stuff in the form of sales taxes. In the end, you are left with precious little, if any, money to pad your nest egg. Frankly, the game is rigged against wage-earning employees, who like cattle are raised to feed the government system. Here is why. The wages you earn from a job is taxed on a graduating scale. The harder you work and the more money you earn, the higher your tax bracket and the greater the percentages of your paycheck you owe in taxes. The federal and state taxes from wage earners are collected from each paycheck and are held by the government, so you never even see it. Further, all wages are subject to an additional FICA tax of 6.65% paid by you, the employee. In addition to your FICA contribution, another 6.65% is matched by your employer, which is part of your overall compensation and could have been used to pay you more if it were not for this tax on your employer. In the end, it is not uncommon for a person to be paying effectively 40% or more of their income in federal, state, and FICA taxes. When you are self-employed or are a business owner, you can reduce your taxable income with many write-offs intended to reward the entrepreneur willing to take the risk of starting a business. There are many deductions that can lower your taxable income without any out-of-pocket expenses to you. For physical or tangible assets such as real estate or equipment, the business owner can use depreciation to lower their taxable income. For intangible assets like research and development, the business can use amortization to lower their taxable income. Further, per diem and mileage expenses used for business purposes can be used to further reduce your taxes. Interest payments and other actual cash flow expenses can also reduce your taxable income even further. Therefore, being self-employed or being a business owner affords you more opportunities to shelter some of your income from the tax man. Being self-employed or a business owner boosts your take-home pay by lowering your tax burden. Of course, this additional income can be used for more consumption, but if you want to become wealthy, you have to put some of that money to work for you. When it comes to investment options, there is a continuum. On one end are investments most wage earners use, like money markets, bonds, and U.S. Treasuries, that are relatively safe and easy to understand by the layman investor, but come at the expense of further tax penalties. On the other end of the continuum are investment classes that are often out of reach of most wage earners that come with significant tax advantages that are the playing field of the wealthy. After-tax money is often invested in financial instruments that pay interest income. Money market accounts, corporate bonds, or U.S. Treasuries are examples of interest-paying financial instruments. All interest earned is subject to taxes based on the taxpayer's marginal interest rate, just like your income from wages. Here again, the more you earn in wages, the higher your tax rate on interest income. Next along the continuum are dividends you receive from stocks you own or on the profit you made from buying a stock low and selling it high. The profit you make between the purchase and the sell price is known as capital gains. Generally, if you own an underlying stock that pays dividends for less than 60 to 90 days, dividends are considered ordinary income. And if you sell the stock and have capital gains, they are considered short-term capital gains. For ordinary dividends and for short-term capital gains, dividend income and capital gains do not benefit from any special tax treatment and are subject to taxes based on the taxpayer's marginal interest rate, just like your income from wages. Here again, the more you earn in wages, the higher your tax rate on income from ordinary dividends and short-term capital gains. Assuming you're married and have $150,000 in taxable income, every dollar of additional income will be taxed at 28%. Said another way, for every dollar of additional income you receive from an investment to this point on the continuum, you get to keep 72 cents and the federal government keeps 28 cents. Further, the state may also get a share of the 72 cents that you have left. If you live in Iowa or California, that may mean giving up an additional 9 cents, dropping your share to 63 cents, while some states like Texas and Florida have no state income taxes. Dividends paid on common stock of a C corporation held for more than 60 days, or preferred stock for more than 90 days, is generally considered qualified dividends. Capital gains on stocks that are sold after a holding period of more than 1 year are considered long-term capital gains. Since the company's profits were already taxed at the corporate level, they qualify for reduced taxation at the personal level. On qualified dividends, the long-term capital gain tax rate is 15%, except for those persons earning $400,000 or more, where the tax rate jumps to 20%. Again, assuming you are married and have $150,000 in taxable income, every dollar of additional income received from qualified dividends or long-term capital gains are taxed at 15% plus your state income tax, which means that you get to keep 85 cents and only give up 15% to the federal government. With respect to investments made with after-tax dollars, most wage earners stop at this point on the continuum. However, for individuals with lots of taxable income that are subject to higher marginal tax rates, they often begin at this point. When your federal marginal income tax rate is on the high end, investing in tax-exempt bonds whose interest is exempt from federal income taxes may make sense. When a state or local government needs to sell a bond to pay for improvements, they issue what is known as a municipal bond. The coupon rate, which is the annual interest rate paid, is generally lower than corporate bonds, but the interest you receive is exempt from federal taxes. Everything up to this point on the investment continuum are for income that was left over after the government took their share. At this point, there are two divergent paths in the continuum. One that allows for retirement investment contributions that grow either tax-deferred or tax-free, and the other path that provides special tax treatments in investment income. Next along the continuum, we'll discuss investments designed to help you build your retirement savings. Pension plans, or IRAs, are funded with pre-tax money. Because the investment uses pre-tax dollars, you get to invest the whole dollar, not the 60 cents you have left after the tax man gets his cut. Your investment grows tax-deferred. Taxes are paid when the assets are sold and are subject to a steep penalty if sold before the age of 59 and a half. Periodic distributions are required when the owner reaches 70 and a half years. Your taxes are based on the sale price versus the basis, which is the price at which time they were purchased. A Roth IRA is funded with after-tax money and grows tax-free. Since the money was taxed before investing, there are no taxes paid when you withdraw from the account. Withdrawals are subject to a steep penalty if sold before the age of 59 and a half, and no periodic distributions are required at age 70 and a half like the traditional IRA. The other investment branch begins with real estate. Real estate produces rental income. Real estate, as an asset class, produces a yearly tax deduction known as depreciation. The annual income from real estate is reduced by the amount of allowed depreciation, shielding some of your income from taxes. When the underlying asset is sold, capital gains taxes are paid on any property appreciation and on the accumulated depreciation taken. However, the investor can use a 1031 exchange to continue to defer the recognition of all capital gains treatments throughout their lifetime by exchanging one property for another. When the owner dies and the property is passed to his heirs, the property receives what is known as a step-up in basis. This step-up in basis is essentially forgiving all capital gains taxes on the property amassed up to that point. Next along the continuum is direct participation oil and gas. An investment made in a direct participation in oil and gas program is divided into tangible and intangible drilling costs. The larger portion of the investment, generally between 65 and 90% of the investment, is considered intangible and can be deducted in the first year. The remaining portion of the investment is considered tangible and produces yearly tax deductions known as depreciation. Further, only 85% of any income received is considered taxable, as the remaining 15% is considered the depletion allowance and is not subject to any taxes. As a wise man once said, it is not how much money you make, but how much money you get to keep in the end that is important. There is a reason that the rich get richer. It is because as their income and wealth accumulate, they understand and take advantage of asset classes that produce income in the most efficient ways possible.